All right, welcome to this explainer. Today we're diving deep into the ultimate numerical and form reference guide for the EA Part 3 exam. Look, as an enrolled agent, you are stepping into a world where precision is literally everything. We're going to master the absolute strictest IRS rules and procedures, and specifically, the hard numbers and forms that dictate how you practice. We've taken a mountain of dense tax law and distilled it into exactly what you need to know to stay completely compliant. So let's jump right in.
We've got this broken down into 6 high-yield folders for you. We'll hit 1. Becoming an enrolled agent, 2. Circular 230 practice rules, 3. Tax positions and penalties, 4. IRS representation and forms, 5. The collection process, and finally 6. Filing and e-file mandates.
Starting right off with Section 1, Becoming an Enrolled Agent, focusing on licensing and CE requirements.
Okay, getting your license is an amazing achievement, but keeping it? That's all about strict timelines. You absolutely have to memorize this number, 72. Once you pass those exams and become an official EA, you are legally required to complete at least 72 hours of qualifying continuing education during every single 3-year renewal cycle. Your exact cycle depends on the last digit of your Social Security number, but that 72-hour benchmark, that applies to all of us.
Now, you might be thinking, I'll just knock all 72 hours out in year 3. Well, actually, scratch that. The IRS completely foresaw that strategy. You cannot cram. You are required to complete a minimum of 16 hours of CE every single calendar year. If you fall short of that annual minimum, you risk being slapped with an inactive status even if you fully intended to make up the hours later. It's just not worth the risk.
And here's the kicker. Out of those 16 annual hours, exactly 2 hours, no more, no less to meet the minimum, must be dedicated specifically to ethics training. This is non-negotiable, folks. Whether you're in your very first partial year of enrollment or you're a seasoned tax veteran, those 2 hours of ethics are mandatory every single year to keep you grounded in the rules we're about to cover.
Moving right along to Section 2, Circular 230 Practice Rules, or as I like to call it, the Ethics of Practice.
Treasury Department Circular Number 230 is your absolute rulebook. Along with IRS Publication 947, this is your mandatory reading. It lays out exactly who can practice before the IRS, your specific duties, and the super strict restrictions on things like how you advertise, managing conflicting interests, and the rules against charging contingent fees. Now, one of the most heavily scrutinized areas under Circular 230 is due diligence. When it comes to fraud-prone benefits like the Earned Income Credit, the Child Tax Credit, or claiming head of household, the IRS does not play around. You have to follow this exact 4-step process on Form 8867. You interview the taxpayer, you contemporaneously document their answers right then and there, you rigorously review the info to make sure nothing is inconsistent, and then, crucially, you have to retain those records for at least 3 years.
All right, Section 3, Tax Positions and Penalties, also known as the OOPS factor.
It's kind of wild how tax law translates human confidence into exact mathematical percentages, isn't it? So, if you take a position on a return, a 25% chance of it being upheld in court gives you what's called a reasonable basis. But you have to explicitly disclose that position on Form 8275 to avoid preparer penalties. Now, if you hit a 33% chance, literally a 1 in 3 shot, you reach the realistic possibility of success threshold. Knowing the exact difference between 25 and 33% is absolutely crucial for protecting your client and your license.
As a practitioner, you need to commit this penalty matrix to memory. And note how these fines are creeping up due to inflation adjustments between 2025 and 2026. A simple, silly administrative error, like leaving off your PTIN or forgetting your signature, is going to cost you $65 per return in 2026, and that is capped at a painfully high $32,500 per year. But behavioral stuff, like failing your due diligence on Form 8867 or breaking the cardinal rule and endorsing a client's refund check, that carries a massive $650 penalty per single occurrence with literally no maximum limit.
Okay, on to Section 4, IRS Representation and Forms, Defending the Taxpayer.
When a client comes to you in a panic with an IRS problem, you really can't just take their word for what's going on. Once you get a properly executed Form 2848 Power of Attorney signed, you get access to the eServices Transcript Delivery System. This portal is going to be your absolute best friend. It lets you completely bypass those dreaded IRS hold times and instantly pull official account and wage records directly from their database. And the real prize inside that system? The tax return transcript. This strips away all the pretty formatting of a standard 1040 and just hands you the raw data the IRS has on file. It's perfect for establishing the baseline facts, finding miscalculations, and letting you see exactly what the IRS sees before you ever even pick up the phone to talk to a revenue agent.
Which brings us to Section 5, the collection process, when clients owe.
So what actually happens when the facts show your client owes money that they just literally do not have? Well, you're going to get intimately familiar with Form 433-F, the Collection Information Statement. This form is basically a financial X-ray. You use it to detail every bank account, piece of real estate, digital asset, and necessary living expense. The IRS uses this exact blueprint to figure out if your client qualifies for an installment agreement, penalty abatement, or an offer in compromise.
Finally, let's wrap things up with Section 6, Filing and E-File Mandates, covering the system requirements.
The days of mailing in giant boxes of paper forms are practically gone, all thanks to a massive recent rule change centered around the number 10. It used to be that businesses had to hit 250 information returns before e-filing became mandatory. Not anymore. Now, if you aggregate just 10 or more forms, like W-2s and 1099s, you are legally mandated to e-file the whole shebang.
Okay, I'd highly suggest taking a screenshot right now. This is your master deadlines guide, and you've got to commit these time limits to memory. Look at the patterns here. Due diligence records, keep them for 3 years. Written consents for conflicting interests and copies of fee advertisements, 36 months. If the IRS flags you with an inactive status notice, the clock is ticking. You have exactly 60 days to respond. And if a client is staring down bankruptcy, the tax return in question has to have been due at least 3 years prior to even be eligible for discharge.
We have covered a tremendous amount of ground today in this explainer, from strict educational timelines to some truly severe financial penalties. Look, with fines easily topping $32,000 a year for basic administrative oversights, precision isn't just a best practice, it is the law. If one single missignature on a Form 8867 can trigger an unlimited string of $650 penalties, you really have to ask yourself, is your current workflow truly bulletproof? Thanks for joining me, and I challenge you to keep reviewing these exact thresholds until they become second nature. See you next time.